protecting Main Street from Wall Street. It's time for Money Unleashed with Eric Johnson and Kyle Allyn.
You have to have a plan where you know if the market's going to go up, what happens next. And you also have to have a plan where if it doesn't go the way you think, you know what you're going to do.
It's time to put you back in control of your money.
I'm not trying to predict the weather, which is kind of what we're talking about, right? It's predicting the stock market. I'm trying to build a better boat.
This is Money Unleashed with Eric Johnson and Kyle Allyn.
This is the Money Unleashed podcast powered by Hoffman Financial Group. I'm Eric Johnson. Alongside me is Kyle Allyn. We got new episodes coming your way every Friday, so make sure you're subscribed to Money Unleashed wherever you get your podcasts. Now, Kyle, we've been talking about the stocks and the greediness of what's going on right now and even the fervor of being in a bull market. I want to flip the script now. I want to talk about the other side of the coin, because when you have a successful portfolio, it's not just your risky equities that are making you the money. Like oftentimes you need to have a safe piece or a backboard, if you will. If you have a 60-40 portfolio, 60% is aggressive, 40% is defensive. We're going to talk about the defensive side now. And where most people have lived before in the past is bonds or bond funds. And nobody really has bonds mostly anymore. It's usually bond funds. And I want to talk about those because not only have they underperformed with the interest rate cuts that have happened, they're year-to-date still down by a couple of points, and they're also still down on the 3-year average. I want to kind of go back to my favorite investor of all time, Warren Buffett. He came out with an article back in 2021, and I invite everybody to Google this. It's Warren Buffett Says Bonds Are Dead. One of my favorite articles. He came out on March 1st of 2021 and basically warned everybody what was about to happen to their bond funds in 2022. Due to the interest rate fluctuations. And because of interest rate fluctuations, bonds have been underperforming. And what's super important to have a successful portfolio is it's playoff football season. Let's talk about football. You need the defense and the offense to be performing well in order for you to win, right? You can't just have your offense score a bunch of points and your defense not show up and just lay down and let the other team score on you. You need to have your defensive side of the portfolio also making money for you. So if you are in bond funds right now, this is kind of dragging down your portfolio, right? Are you seeing this every day like I am?
Absolutely. And I love the way you place it, which is everyone comes in, they're like, hey, what's the new hot stock? How do I make more money? Well, one of the fastest ways to make more money is to clean up the defensive position. Ray Dalio said cash is trash. Warren Buffett said bonds are dead. I had an opportunity a couple years to go up to the University of Yale, right? So one of the big institutions, and interview a Nobel Prize-winning economist, Dr. Ibbotson.
Roger Ibbotson. The guy's the man.
He went into the depths of the library and he dug out all this information on the stock market, and he was looking at all these different things about the S&P 500. And what he actually came out with was an idea for protection. And he said, hey, a great replacement for bonds would be specifically fixed index annuities. So a lot of times when clients are hearing about annuities, they're thinking about pensions. I would argue that an even better way to think about them is a replacement for bonds. And I'll explain why. You mentioned earlier that over the last 3 years, the bonds have been losing money even with the changes in the interest rates. Well, these fixed index annuities a lot of times are connected to the S&P 500. So as the market's doing well, up to a certain position, up to a cap, you get market placement. Now, I want to be clear. Anybody that's saying an annuity runs like a stock, runs like the market, that's not what I'm talking about.
Totally incorrect.
Annuities cannot replace your stocks. You need stocks. You need the high growth of those equity proponents. But on the flip side, when you look at the annuity compared to the bond, oh my gosh. And right now, some of the companies are literally offering products with no fee, full protection, and market-like return up to a point. So let's say, okay, what point? Generally, what they're going to do is give you 2 to 3% above the treasury rates. So if you're looking at the treasuries, and we see that back in the day they were at 0.75, then these products will average about 3 to 4. Right now, with the treasuries up around 3 to 4, they can average up to 6, 7, 8. So the point being, they're going to give you more accumulation in that protected side of your portfolio. So if you said, hey, how do I replace bonds? Well, this is one of the many ways to do this. So one of the things that we do as fiduciaries is help you look at different things that you may have never thought about before. It may have never been offered to you before. One of the things that I'm a big fan of is using these protected products from insurance companies to ultimately make more returns on the safe money.
Yeah, so imagine a world where your stocks go up by 20%, but your bonds go down by 2%.
You mean today? You mean right now? You mean this year?
Kind of. How did you know that was getting to? Because that's the world we're living in right now, right? Now, let's flip the script a little bit. Imagine your equities go up 20%, but your defensive money goes up 6%.
Yeah.
Right? That's super powerful. And I kind of want to clear up the word on annuities real quick, because oftentimes when we talk about them, I get an eye roll, or some people are like, oh, goodness. So let's talk about the misconceptions about these, because I know that it was a dirty word for a long time, right? But however, much like the iPhones that keep coming out, these are getting better and better and better. And I want to kind of describe to everybody out there the types of annuities that are out there and ways you can use them. First of all, you've got something called a multi-year guaranteed annuity, right? That's very similar to a multi-year CD. And those can give you a guaranteed rate of return, which is nice, something you can count on. However, they can be difficult because if you'd like to get out of those, there's about a month window before they renew. And if you don't exercise or get them out after that, you renew, and then there's penalties to get out. So that's not so great. And then you've got variable annuities. So sometimes you hear people on the radio saying they hate them. These are the ones that they typically are talking about. And I'm not a huge fan of variable annuities either. Why? Because they're super high in fees. You're paying a fee to the insurance company. You're also paying fees for the expense ratios of the mutual funds that are inside of them, which typically underperform. And oftentimes you're going to be paying more in fees than you are in getting gains, right? So those aren't great, and I've never recommended one of those to anybody, nor would it even my worst enemy.
Well, let me pause you there. Every rule has a time when we want to say, hold on. And I want to pause you right here. Some of you have these variable annuities from way back.
Yeah.
Some of those are garbage, to your point.
Yep.
I've seen a few clients that were in very rare cases that were actually pretty good. And
sometimes.
And the reason I bring this up is we do the annuity stress tests on clients.
Yep.
We give you the ability to understand. So, sometimes when they hear us talking about things, they being the people out on the radio world, they're like, okay, they're for this or they're against that. I want to be clear, and I'm going to let you continue. We just want to make sure whatever you have is the most premier version of that thing. So if you've bought a variable annuity, let's make sure you have the best one. If not, just replace it.
Yeah, replace it with something that's going to be a better mousetrap, if you will. And I like what you say. There's always an exception to the rule, right? So you've got multi-year guaranteed annuities, those kind of look like CDs. You got variable annuities. And incidentally, on variable annuities, you do have the ability to lose money, right? That's not what you're looking for if you're going to be wrapping your money up for an extended period of time. Well, then imagine if those two kind of had a baby. And that's where the fixed indexed annuity comes in. It's fixed. You can't lose your money, just like a multi-year guaranteed annuity. And then it's indexed to like the S&P 500. Sometimes it's an exotic index, but I prefer S&P 500. And the reason why these are a handy tool is you can index at the S&P 500. You might be able to make up to 6 or 7% on these. Sometimes you see offerings of 8 or 9% you're allowed to make on the S&P 500, but you can't lose. And those are very low fee. And now there are two ways you can use an annuity. You can use an annuity for income, which could be okay if we're worried you're going to run out of money. I don't like to use them that way. I like to use them as a bond replacement like you're talking about. So if you've got a bond, for instance, and on the 3-year average is down a couple points, or you could get into something that gives you actual protection from the market and protection from interest rates, and you can base it off the S&P 500 and make upwards of 5, 6, 7%. That's a game changer. I mean, that is basically taking your bond fund that's been on the 10-year average making a couple points, and you're injecting it with a steroid. Like you're taking your defensive money and actually growing it. But what's nice about these is you've got access to them. And we have a lot of them that have return of premium features that are allowed to be on there too, which means you can take your money back with no penalty. So if you take the access of these fixed indexed annuities and replace them as a bond, and imagine every year you could take 10 or 20% out of it and then cost average back into your stocks, that's really powerful, because what you've done is you've basically said, okay, this percentage, let's call it 60-40 portfolio, this 40% is my backboard. I know that I can't lose a dime in here. And if it appreciates, I can take it out and then cost average back into my stocks. So what does cost averaging mean? That means you're constantly adding to your stock positions as the market's going up. It's a nice, safe way to add positions into your stocks. And what happens, it's kind of like rising tides lifts all ships. Your equities go up, your safe money goes up. You take money out of your safe money, add it to the equities. That is how you hit certain levels of wealth. And what it actually does, it mimics Warren Buffett's strategies, right? So you're familiar with Berkshire Hathaway, Kyle, and I'm sure most people are. The top position for Berkshire is Apple, right? So if Warren Buffett's Apple goes up 10%, does he sell all of it, Kyle?
No.
What he does, if his Apple goes up 10%, he pulls off 7% and he reserves it off to the side for Apple. Now he leaves 3% in there in case he's wrong, because even the Oracle's wrong from time to time. And if Apple keeps going up, he's still compounding. Well, eventually when Apple does go down, he's taking that extra money and buying it back into Apple. And you and I both know you cannot time the market. You need time in it. That is the key. Warren does this exercise over and over and over again. And over time, what happens, it smooths out the line of volatility for Apple, and then he's got more money than everybody else. And these are the types of strategies that we provide for our clients when they come in looking to make money right before they're getting ready to retire and in retirement. And that's why you need to have your defensive money actually hitting the ball a little bit for you. And that's what we do every single day for everybody. We do it with a portfolio x-ray, and then it comes into creating a retirement plan. So if you need one of these plans, here's what we're going to do today. I tell you what, I'm feeling generous. It's the holiday season, and this is what we're going to do for the listeners out there. You need to have a full financial plan. Let Hoffman Financial Group help design this for you, and it's specifically just for you. We make a la carte plans. There's no cost and no obligation to this, and we create a full financial plan. Kyle, tell everybody what's in the full financial plan.
Yeah, so we're going to start with the building blocks of income. So we're going to look at your pension, if you have one. We're going to look at your Social Security. Then we're going to move into the distribution. So we're going to look at the different account levels. So do you have a tax-deferred account? Do you have a tax-free account? Do you have a taxable account? Then we're going to move quickly into time. So we're going to look at the rest of your life and those distributions to try to figure out, okay, can you make it 20 years? Can you make it 30 years? And then we'll finish with taxes. So the last piece of the puzzle will be a discussion around who gets that money next and what are the tax consequences of those distributions.
Yeah, so we also take care of legacy as well, too, if that's a priority for you. Guess what, guys? We do this all at no cost. And I tell you what, for the first 10 callers today, we'll be happy to set you up with an appointment to get one of these full financial plans. Give us a call, 404-341-6767. That's 404-341-6767. Or you can check us online at unleashyourmoney.com. Kyle, and one of the biggest things that you just said with the full financial plan is tax planning. Talk to me a little bit about that and how we help people with that.
Absolutely. So one of the things we want to understand is the tax consequences of the choices that you're making. I literally had this conversation yesterday. So you were just talking about using annuities as bond replacements. And I love that the way you talked about it was about having a plan, not having a product, right? If I were to say, hey, what was Eric just talking about? He's saying, hey, use these as your plan. Use these as a strategy. Don't use them as just a product. We're not just selling products. And so one of the strategies, one of the plans around those types of products would be using them to defer taxes.
Yes.
So sometimes the question is, should I defer my taxes or should I pay them? So, of course, everybody's got to look at their unique layout of their family, their unique layout of their money. So there's 3 different types of accounts that you're going to have. You're going to have a tax-deferred account, you're going to have a taxable account, and you're going to have a tax-free account. So one of the things we do as financial advisors is, 1, help you identify those accounts, and then 2, understand how they operate together and when it's time to get rid of certain ones. So there's lots of different strategies around that. There's lots of different products that will help that to build out a great tax plan inside of your income plan to maximize all the hard work that your investments are doing from a tax standpoint.
That's right. Where your money's coming from is just as important as how much you're taking out. If this sounds like you and you haven't had this done yet, please give us a call. We'll do this for you. No cost, no obligation. Give us a call if this sounds like you. 404-341-6767. That's 404-341-6767. Or you can go online and check us out on unleashyourmoney.com.
Eric Johnson and Kyle Allyn are investment advisor representatives of Brookstone Wealth Advisors, LLC, a registered investment advisor and affiliate of Brookstone Capital Management, LLC. BWA and Hoffman Financial Group are affiliated under common ownership. Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interest of our clients and to make full disclosures of any conflicts of interest. Please refer to our firm brochure, the ADV2A, page 4, for additional information. The Hoffman Financial Group and WSB are not affiliated. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. This information should not be considered tax or legal advice. Individuals should consult with a professional specializing in the field of tax, legal, accounting, or investments regarding the applicability of this information for their situation. Any client experiences discussed during the show are unique to that client. They are not meant to imply or suggest you will experience the same results. Past performance is not a guarantee of future results. Investments will fluctuate and when redeemed may be worth more or less than when originally invested. Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone. Index or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract. Please refer to our firm brochure, the ADV2A Item 4, for additional information. Hoffman Financial Group is not affiliated with or endorsed by the Social Security Administration or any other government agency. Insurance licensed in Georgia, number 163546.